Hi everybody. We account for long-term notes receivable pretty much in the same way we account for short-term notes receivable, but the time value of money has a larger effect. Therefore, if long-term notes are received in exchange for goods or services, the financing component of the transaction typically is viewed as significant for revenue recognition purposes. Let's look at this example. Stridewell Shoe Company sold shoes to Harmon Sporting Goods on January 1st, 2021, accepting a $700,000 two-year note in payment for the shoes, assuming a 12% effective interest rate. It's useful to consider a couple of aspects. First, notice that the sales revenue in 2021 is not recorded for the full $700,000. Instead, sales revenue is recognized as the present value of this number. It's calculated using the present value table 2, where n equals 2, I equals 12%, $700,000 times the appropriate factor equals a present value of $558,036, and that's what's recorded as our sales revenue. We're going to debit notes receivable $700,000. We're going to credit sales revenue for the present value of that $700,000, and the difference between the two is credited to discount on notes receivable, $141,964. That is the amount of interest revenue that we will recognize over the 2-year period. Now, the interest revenue each period is calculated based on the net note receivable. This is referred to as the net note receivable. And we're going to compound the interest. So on December 31st, 2021, which is 1 year's worth of interest, we're going to take the net note receivable, $558,036, multiply it times 1 year's interest, which is 12%, to calculate interest revenue of $66,964 for the year 2021. Debit the discount on the notes receivable. Now next year, using the compounding of interest, we're going to charge 12% on this number plus this number. So interest revenue for 2022 is 12% times 558,000 plus 66,964, and that calculates to $75,000 of interest revenue in the second year. Credit interest revenue and debit the discount on notes receivable, and we're getting paid at the same time. So debit the cash for this note receivable amount and credit notes receivable. That could be done in 2 separate journal entries, but it's just as easy to combine it into one journal entry. I think you have a homework problem similar to this, and they definitely want one journal entry in the final, when you receive the final payment. Notice that $66,964 plus $75,000 debits to discount on notes receivable totally eliminates this initial credit on notes receivable, discount on notes receivable. So here's a problem for you. Finkel sold merchandise to a customer in exchange for a 4-year non-interest-bearing note for $10,000. An equivalent loan would have a 10% interest rate. Finkel would record sales revenue on the date of sale equal to what? Pause your video, give some consideration to this question, choose your answer, then start your video again and see if you got the right answer. Is it C, the present value of $10,000 discounted at 10% for 4 years? Yes, it is. If a note with an unrealistic interest rate, even a non-interest-bearing note, is received solely in exchange for cash, in other words, this is not a sales transaction. Someone needed to borrow $700,000 and Stridewell Wholesale Company loaned them $700,000. Then the cash paid to the issuer is considered to be the note's present value, even if this means recording interest at a ridiculously low or zero rate. The amount of cash exchanged in this basis for valuing the note is $700,000. If the non-interest-bearing note in the previous example had been received solely in exchange for $700,000 cash, the transaction would be recorded debit note receivable, credit cash, $700,000. This is a good spot to end this video. In the next video, we'll talk about bad debts on notes receivable.